Good morning, everybody. Uh, Welcome to the Provincial Exam Prep Seminar, webinar by Olivers. This webinar, we presume that all the students who are attending have good knowledge, as most of them must have passed the certification exam. So this webinar is going to touch upon the concepts as well as try to explain some of the important concepts, and then we practice some questions. We will not be going into details and depths of everything because it's presumed that the student has an idea. My name is Soma, and I'm an instructor at Olivers. We begin today with an agenda. In the first part, I'll cover some of the taxation and estate planning issues and why we buy life insurance. Then we take on life insurance contract and underwriting issues. The third part, we take on life insurance, insurance needs, calculations. The fourth part, we take on disability insurance, and we discuss the different kinds: total, partial, residual, recurrent, and the group insurance. We then move on to investments, mainly about segregated funds. And then we touch upon retirement planning concepts. So that is the agenda for the day. Let's begin by understanding why people buy life insurance, the reasons, the needs, why they buy personal life insurance policies. You know, a person, for example, has a mortgage. The person and his spouse may want to insure themselves for the amount of the mortgage so that if one of them dies, the insurance pays out the money, and that money is used to clear off the mortgage so that the surviving family, the spouse and children, can live in a mortgage-free home. Similarly, you have children's dependency period. When children are minor, young, the spouses may want to insure themselves for a certain sum of money so that if one of the child dies, the surviving spouse receives lump sum money and can use it to look after the children better. Or children's education. Parents may want to insure themselves when they have young children so that if one of them dies, the lump sum money is used for educating the children, for the university education. Similarly, loans and debts, if a person has, he may want to insure himself so that if one of them die, the loans and debts of the family are cleared. Now, these needs that we have discussed so far, the mortgage, children's dependency period, children's education, loans and debts, these have something in common. We know when the risk starts for a family or a person. We also know when the risk is likely to finish. For example, if a person has taken a mortgage and he plans to clear it in 20 years, we know that the risk is likely to exist for this person for 20 years. Similarly, if people have children who are 5 years and 6 years old, probably the risk for children's dependency and children's education is going to exist for 15 or 20 years more. We can estimate the time frame for the risk. When we can estimate this time frame for the risk or the end point of the risk, we call such a risk a temporary risk or a temporary need. And temporary needs are best covered by a product called term insurance. And in term insurance, as we shall see, there is the non-renewable term, the renewable term, the convertible term, and of course the renewable and convertible term. Term insurances are typically the cheapest product a person can buy at any point of time. The shorter the term, the premiums are going to be less. It's used for covering all temporary needs. Whereas a person may have permanent needs. For example, a person may want to cover himself for his funeral expense. If a person wants to use life insurance to cover his funeral expense, we know that we cannot estimate the end point of this risk. There's no time frame. We need this insurance whenever the man dies or the person dies to pay out this expense. The policy needs to be in force whenever death occurs. When this happens, the funeral expense has to be paid out. Therefore, this is a permanent need. We cannot estimate the end point of the risk. Another reason can be estate taxes. We shall see what these taxes are, and I'm sure most of you understand it. Estate taxes, if a person needs to pay, again, the insurance policy definitely needs to pay out the amount when the person dies. So it's a permanent need. Estate creation needs. These are when a person wants to leave money for a loved one or a charity. You know, different words may be used to describe this kind of need. They might say the person wants to leave a legacy to his university, or the question might say the person wants to leave a bequest for his granddaughter, so in his will. So whatever it is, it all refers to this kind of a need where a person wants to leave money on his death through life insurance policy. He's creating wealth by dying. And then there is the estate equalization need, which is used when you want to achieve an equitable distribution of an estate between the heirs. For example, there might be the family, spouses who own a home which is worth $500,000. And they may own a cottage which is worth $300,000. Let's assume they have 2 children and they want to distribute this property equitably amongst them. One of the ways would be to sell both these properties and give $400,000 each. But practically people do not want to sell the property when they die. They want to pass it on intact to their children. So assume they give the child A the home and child B the cottage. Clearly child B is receiving $200,000 less by way of distribution. So what these parents might do is buy a life insurance policy for $200,000 and name child B as the beneficiary. So when they die, the child B gets the life insurance policy of $200,000, the benefit, and the cottage $300,000, making it equal to what child A receives. Using life insurance in this way to achieve equitable distribution of an estate is called an estate equalization need. And of course, there is the surviving spouse's need. The spouse may want to leave money for the survivor, the first dying spouse, so that the surviving spouse can lead his or her life in a manner with a lifestyle that they intend for her or him. Now these are all permanent needs. You need to have money whenever you die. You need the policy in force. Now these needs are best covered by the permanent insurance products, which are the term to 100, the whole life insurance, and the universal life insurance. We shall compare these products and get an idea of what these products are about. So these are the reasons why people buy insurance. So here's what I want to tell you. When you get a question in the exam, try to understand from the question which of these needs is being addressed by the question. And then decide whether you're going to give a permanent product or a temporary product. It is based upon the need. Of course, for example, you may be able to cover a permanent need with a renewable and convertible term, which means the person, because he cannot afford to buy a permanent insurance right today, buys the convertible term. And later, as and when he or she can afford the premiums, they convert it to a permanent policy. But remember, whatever it is, when you buy a convertible term with the intention of converting it, you're actually covering a permanent need. You're using the term insurance as a stepping stool to get to permanent insurance. Let's just take on taxation and estate planning. Now, investment income. When a person makes money by investing, he can make money in three forms. He can make money in the form of interest, in the form of dividends, and in the form of capital gain. Now, all of us know that interest income is taxed every year on cash basis or accrual basis, and it's taxed at the marginal tax rate. So a person receives interest income is just like receiving salary or anything. You got to declare the whole thing as your income and calculate your taxes. If you receive dividend income, you have to report it annually though, but you get a preferential treatment. You get a gross up and a credit from the government. The gross up and credit serves to reduce the actual tax that you pay compared to what you would pay on interest. So dividends get a tax preferential treatment. You gross it up by 1.45 and then give a dividend credit. The provincial credit, the federal credit is 18.97%, and the provincial credit varies by province. So let's say the provincial credit is 6.03% plus the federal credit is 18.97, the person would get a 25% credit. If he has to pay tax at 35%, let's say his marginal tax rate is 35%, and he gets a 25% credit, in effect he is paying only 10% tax on dividend. So that's the way dividends work. You get a tax preferential treatment, though you need to report this income annually. And then we have the third form of income, which is the capital gain. Capital gain income is made essentially, you buy a property at a certain price, you sell it at a higher price. The difference is capital gain. Now, when you make a capital gain, only 50% of the capital gain needs to be declared as your taxable income, which means you're going to pay half the tax that you would pay on interest if you make it by way of capital gain. So you get a tax preferential treatment on capital gain income. But also, a point to note here is capital gain income needs to be reported only in the year it is realized. You don't have to report it on accrual basis, which means let's say I buy a property, let's say I buy a particular share, and the share is increasing in value every year. I don't need to report this increased value annually till I actually sell the share and realize the capital gain. So it is deferred. It gives me a tax deferral opportunity, investing into capital gain property. Whereas interest, I would have to declare it even if I did not receive money, even if it accrued in the investment. I would have to declare it. In a capital gain situation, it's accruing, but I don't need to declare till I actually dispose. So it gives me a tax deferral opportunity. So that is a table there which shows you the differences in taxes: salary, interest, dividends, capital gains. Dividends and capital gain give you a tax preferential treatment. You pay less taxes on them. Now, dividend and capital gain, which one gives you more advantage will depend upon your marginal tax rate. People at the higher marginal tax rate, clearly capital gains is better. But for people at the lower marginal tax rates, maybe the dividend income is better. But dividend income does not give opportunity for tax deferral. Now, because capital gains gives you a deferral opportunity, how long is it deferred? If a person does not dispose this property, there is no capital gains tax paid by him. When he dies, the deferral ends. The government is going to trigger a deemed disposition on his death, and his final tax expense tax filing returns have to include the capital gains on the property that he owned, where the proceeds of disposition will be taken as the fair market value of the property, whatever it is on the day of death. So capital gain is calculated as the proceeds of disposition minus outlays and sales expenses minus the adjusted cost base of the property. What do we mean by adjusted cost base? By adjusted cost base, what we mean is how much tax paid money or after tax dollars is invested in the property. Now typically it is calculated as the purchase price plus the allowable purchase expenses. So if you buy a share and pay some commission to the broker for the purchase, the ACB of the share would be the price you paid for the share plus the commissions. Now after you calculate the capital gain, the taxable capital gain is 50% of the capital gain, and the tax is taxable capital gain times the marginal tax rate. So you will find on the slide an example worked out. You may go through that and see how capital gains tax is calculated. Purchase price 95,000, commission paid 5,000. So the ACB of the property, which was purchased in 1999, was $100,000. The purchase price plus the commission paid. Property was sold in 2010 for $180,000 and commission paid was $10,000. So the capital gain is calculated as the proceeds of disposition, which is $180,000, minus the commission paid for sales, $10,000, minus the ACB, which is $100,000. So it should give you a capital gain of $70,000. Now of the capital gains realized of $70,000, the taxable capital gain is going to be half of that, or $35,000. So the tax the person would pay, assuming a 40% marginal tax rate, would be 40% of 35,000 or $4,000, 4,000 something dollars. Now the point is that if you get in your question that the person made a capital gain of $50,000, you know that that is the amount of capital gain realized by the person. The taxable part would be $25,000 in that case. But if the question tells you the person made a taxable capital gain of $25,000, please understand that the 50% has already been applied on the capital gains. You just have to multiply it by the marginal tax rate. I think that figure there needs to be corrected. The tax that would be paid at a marginal tax rate of 40% on $35,000 would be $14,000. The one is missing in the answer. It should be $14,000. If the person dies and the sale had not taken place, and if he had died in 2010, the calculation would have changed. The fair market value of the property would be taken, and then this calculation done. Now, while you stand to make a capital gain when you buy a property, you may also make a capital loss. Capital losses, if you are made, can only be adjusted against capital gains. You cannot adjust it against any other form of income. So let us say I bought some shares for $10,000 and sold them for $5,000. And let's assume that I made a capital loss of $5,000. And I have no other capital gains in this year. Now what I can do is either go back 3 calendar years. If I made the loss in 2010, I could go back into my tax filing of 2009 2008, or 2007, and if I filed any capital gain in any of these tax returns, I can go make an adjustment against that and get a tax refund from the government. But let's say I don't have any capital gains filed in the last 3 years, or I just don't want to go back and use this 5,000 loss. I am free to carry this loss forward indefinitely and adjust it against any future capital gains. So to repeat, if you make a capital loss in a particular year, you have to offset it against any other capital gain that you made in that year. It's mandatory. Now, if your capital losses exceed the capital gains in the year, the excess, the net capital loss that you have, you can go back 3 calendar years, or you can carry it forward indefinitely. Now, we have seen the different kinds of income that can be made, but we can complicate matters by looking at different kinds of accounts too. Typically, as far as this course is concerned, let's look at 2 kinds of accounts. One is the non-registered account, which is the ordinary account that you open. You go to any bank or financial institution, open an account, it's a non-registered account. The money you invest into this account is your after-tax dollars. You don't get any deductions for tax purpose or anything for putting in money into that account. Any growth that takes place in this investment annually, you have to pay tax, whether it is interest or dividend. You have to pay tax. Even if it's capital gain, by selling some shares or something, whenever you make a capital gain, you have to pay it annually. Capital gain is taxed on earlier of disposition or death. That's a non-registered account. The other side, it should read registered account. Registered accounts, we stand corrected there, it should be a registered account, not a non-registered account. The principal that you invest into this account is before tax dollars, because if I put in $10,000 into my RRSP, I get a tax deduction for $10,000. So I don't pay tax on that $10,000, making it before tax dollars. Let me just clarify one thing here. When we are talking about registered accounts here in this webinar, we are talking about the retirement registered accounts, which consist of RRSPs, RIFs, LIFs, LRIFs. Now, growth in these accounts are also not taxed. The taxation takes place on withdrawal, on both principal and growth, just as interest would be taxed. Whatever you withdraw from this account, you pay taxes at your marginal tax rate. There's no tax preferential treatment. Even if you made the income by way of dividends or capital gains, it doesn't matter. When you take out the money, you pay tax fully. Now, obviously, it's a tax deferred account, and the deferral holds till the person dies. The balance in the account is taxed on the death of the annuitant. When the annuitant dies, the owner of this account dies, this account is considered deregistered. And the balance there is taxed to the deceased in the deceased final tax returns. The balance itself may be passed on to a beneficiary. If a beneficiary has been named, the balance would be paid out to the beneficiary. However, the final tax returns of the deceased will have to include this balance as income and pay tax on it. Now, when a person dies, his estate is crystallized. Crystallized means it's frozen. Nobody can transact any business on any of his belongings, whether it's a bank account, an investment account, a real property, whatever it is, it's all frozen. Nobody can transact. The ownership of each property belongs to the dead person still, because it hasn't been disposed. That is called an estate. An estate is a testamentary trust. which forms automatically on death of a person. Now, most of the assets and properties owned by the deceased would form a part of his estate. However, there are some things that do not enter the estate, do not go to the estate. One is the death benefit of a life insurance policy paid to a beneficiary. These accounts that we are talking about now are called beneficiary designated accounts. They consist of the life insurance policies and the registered retirement accounts, RRSPs, RIFs, LIFs, LRIFs. Now, if a beneficiary has been named in any of these accounts, the money passes directly to the beneficiary, bypassing the estate. Now, if no beneficiary has been named in any of these accounts, it would be paid into the estate. It would now form a part of the estate, the balance. And even though in the case of a registered account, the money is paid to the beneficiary, the balance in the account will have to be added to the income of the deceased person and taxes paid. Now, once the estate forms, it goes through a probate process. It goes through the probate courts. As we know, death may be testate or intestate. Testate means the person died with a will in place, and intestate means the person died without a will. In either case, doesn't matter. The estate goes through a probate process, and one of the main things that happens in a probate process is the executor of the estate is appointed. The executor is the person named by the court to look after the estate or the deceased estate. Now, normally in a will, most people or almost everybody names an executor whom the deceased would prefer to have as an executor. Now, if there is such a name and the court finds that that person is willing to do it, they would appoint the person as the executor. If no will is there, the court appoints somebody. Usually the court also tries to find somebody near and dear, like the spouse or children, and if it cannot find anybody suitable, it appoints one of their own officers to look after the estate. Now, once the executor is appointed, the executor gets all the legal powers necessary to operate on the dead person's assets and properties. One of the first tasks, in fact, the first task of the executor would be to determine how much taxes are owed by the deceased. Calculate those taxes. He doesn't have to calculate it himself. He can go to a tax specialist and get it calculated. He needs to pay the taxes and obtain a clearance certificate from the CRA. Nothing can be done till this clearance certificate is obtained from CRA. The estate is frozen still. You need to pay the taxes. Now, one way a person can postpone these taxes is by naming the spouse as the beneficiary of each of his properties or of his estate. Now, if the spouse is named a beneficiary, the spouse can roll over the property to his or her name, and there will be no taxes to the deceased. In fact, this is called the spousal rollover, and you can do it when you're living or you're dead. It doesn't matter. You can roll over property to your spouse. If I own a cottage, I can transfer the cottage to my spouse and not pay taxes on it. That's the difference between a transfer and a rollover. Let us say I own a cottage. Let me go a little bit this side. Let's say I own a cottage with an ACB of $100,000. of $100,000, and the fair market value today is $300,000. If I opt to transfer this cottage to my son, I will have to pay the tax on the capital gains. So I would have to pay tax on the $200,000 of capital gain. That's $100,000 taxable capital gain. If I assume a 50% MTR, I would have to pay a tax of $50,000. 200 is the capital gain, 100 is the taxable. At 50,000, I would pay $50,000 in tax. And the property would pass to my son. The ACB of the property for my son would be $300,000. This is the transfer. It goes at the fair market value to the person receiving. It's considered a disposition. It's a disposition. But if I choose to roll over the property to my spouse by a spousal rollover, I do not pay any tax on this property. And the property rolls over to my spouse at my ACB. And any further taxation on this will be done based upon the $100,000 ACB. So you can opt for a spousal rollover. Now you can do it in your will. If you have named your spouse as a beneficiary of all your properties, on death, the property rolls over to the spouse, and you need not pay taxes on the property. So except for spousal rollover. So same way, if I have a registered account, an RRSP or a REF, and I've named my wife as a beneficiary, when I die, my wife can roll over that to her RRSP. It's a special transfer. She need not have balance or anything. But it will be taxed when she withdraws at her marginal tax rate. So rollover. After taxes have been paid and rollovers and other things done, the next task of the executor is to pay up all the creditors, whoever this deceased owed money to. He needs to pay taxes, pay the creditors, pay his debts. After all the creditors have been paid off, the estate can be distributed to the beneficiaries or the heirs. Again, if there was a will, the executor would normally follow the will and distribute the remainder of the estate as laid out in the will. If there is no will and the death is intestate, then the intestacy laws of the province would be followed and distribution will be done accordingly. So this is the procedure followed when a person dies. So what are the taxes that need to be paid when a person dies? You need to pay income tax. That means income earned after the last tax filing, whatever has been earned by the person till he died, you'll have to pay tax just like anybody else. As we discussed, any balances in registered account will be added to the income when it's not been rolled over. And then the person needs to pay capital gains on all tax, on all properties, capital properties, which will be calculated as the fair market value minus the ACB when it's not been rolled over. And the probate court, for doing all its services, it charges a tax. It varies province to province. In Ontario, for example, I've given it there on the slide, it's 0.5% on the first $50,000 value and 1.5% thereafter. So practically, for our discussion, let's take it that the probate tax is 1.5% of the estate value. It varies province to province. The government also gives certain tax exemptions. That means on which people need not pay any taxes. One is capital gains on principal residence. Now remember, a family owns one principal residence. That means two spouses together own one principal residence. And the principal residence or the matrimonial home, when it is sold and you make any money on that by the sale, capital gains, you need not pay any taxes, whether you are alive or you are deceased. It doesn't matter. There is no taxation on the capital gains of a principal residence. There is a $750,000 lifetime capital gains exemption on capital gains that are made on qualified small business or a qualified farm or a qualified fishing property. Now, if the small business that is owned or invested by this person qualifies to be called a small business and he makes some capital gains out of disposing that, up to $750,000 of capital gain he can write off during his lifetime. Now remember that this capital gain has to come from the qualified source. If you just invest in some land or something and make some capital gain, you can't write off this against that. It has to come from that source, from a qualified small business, a qualified farm, or a qualified fishing property. Life insurance death benefit paid out is tax-free. Growth in a tax-free savings account, never taxed. And lottery winnings. These are the tax exemptions available in Canada. Let us assume that this is the estate of a person when he dies. As you can see, he's got a principal residence on which he doesn't have to pay any tax. He's got a cottage on which he needs to pay a tax of about $75,000. He's got RRSP balance of $200,000, which is fully taxable. He pays about $100,000 in tax. And he has a business on which he's made a capital gain of $400,000. So he would end up paying $200,000 in taxes. So the total tax owed by this estate would be $375,000. Plus the probate tax, which I told you is about 1.5% of the value of the estate. The value of the estate, as you can see, we reckon at $2 million. So roughly $30,000 will be the probate tax. So more or less, this estate would have to pay a tax of something like $405,000. But the problem with this estate is there is no liquid asset to first pay the tax. Everything is locked up in properties. Maybe the RRSP if he has not named a beneficiary. But if he has named a beneficiary, the money, $200,000 would have been paid out to the beneficiary. So no cash is available. So the executor of this estate would probably have to sell some property to clear the tax of $405,000. This tax could have been avoided if this person had opted for a spousal rollover. That means named his spouse as a beneficiary of all these properties, if it was possible. So the executor of this estate is going to have some problems. One way of, one solution that could have been there for this estate was this disease. Let us assume he had a life insurance policy for $500,000 and he had named his son or daughter as a beneficiary. Now the son or daughter would have received the $500,000 and they could have cleared this $405,000 and released the estate. Got the clearance certificate. It may not always be possible to name a son or daughter as a beneficiary of a policy. In such cases, you may name the estate as a beneficiary. Now, if this person had a policy for $500,000 and he had named the estate as a beneficiary, the life insurance proceeds of $500,000 would have come into the estate, into his bank account, which means the value of the estate goes up to $2.5 million from the earlier $2 million. His taxes, however, remain same because there's no tax on the life insurance proceeds. But there is a slight change because the probate tax, which is 1.5% of the estate value, goes up slightly. From 35,000, for example, in this case, it's estimated at 37,500. So instead of paying $405,000 in taxes, this person would end up paying about $412,000 in taxes. So naming the estate as a beneficiary is not a bad idea, especially because the executor gets the money immediately to clear off the estate and take care of the beneficiaries. The whole problem is if it takes time to get the clearance certificate and clear the creditors, the estate still remains frozen and cannot be distributed to the beneficiaries who may be in need of income or properties from this estate. So naming an estate as a beneficiary, there is a slight increase in tax, that is the probate tax part, 1.5% or 0.5% increase, which I think is okay for the convenience. Try this question. I'll give you 1.5 minutes to answer it. I'll give you 2 minutes actually. All right. So how do we go about doing this? The principal residence, there is no taxation, so we can ignore it. On the cottage, there has been a capital gain of $100,000. So the taxable part is going to be $50,000. The RRSPs, both are taxable fully. So he has got an RRSP total of $450,000. That's what they have, the couple. Fully taxable. These are all Ks, thousands. The stock portfolio has a $100,000 capital gain, which means taxable is $50,000. And the IVIC has a capital gain of $100,000, which means the taxable is $50,000. So the total here works out, taxable part is $600,000. That's what the estate will need to pay taxes on. At 50%, the calculated tax would work out to $300,000, which the answer is C. Try this question. I'll give you a minute and a half. I think when you do these questions, the kind of approach to follow is read the main question first and read the 4 choices. If you read the main question, it is which of the following statements is true. Read the 4 choices and see whether you can identify which is true. By immediately transferring title of the cottage to her children, Reena could avoid tax and probate issues upon her death. That's clearly false, because when she transfers the cottage to her children, she'll have to pay taxes, as we saw earlier. Tax will have to be paid. It's a transfer. Upon her death, Reena will realize the capital gain of 100,000 and a taxable capital gain of 50,000 due to growth in her RRSP. Is that true or false? Clearly it is false, and the reason for it being false is because you cannot have a taxable capital gain in your RRSP. RRSP is fully taxable, whatever it is. There's no capital gain in an RRSP. C, by naming her estate as the beneficiary, Reena would be able to use the proceeds to pay her tax liability on her cottage and RRSP, as well as any probate tax. That is true, because we saw it in the second example of the estate when the life insurance proceeds came in. It was used to pay the taxes and the probate tax. C is true. D, by naming her children as beneficiaries of her RRSP, she'll avoid tax. I told you, except for the spousal rollover, in general, RRSP or registered account balances are fully taxable to the deceased. Cannot avoid tax by naming children as the beneficiary. So the answer is C. Now to do this question, I probably did not even have to read the story. All I'm trying to point out here is, if your concepts are clear, you will be able to identify which is true and which is false. And you should be able to home in on the correct answer. In some cases, you may have some difficulty between 2 choices to say which is true or which is false. In that case, you might need to just read the story to identify the difference or what is correct. Try this question. I'll give you a minute. So this question is testing whether you know when probate tax will be charged on the proceeds of life insurance. Now, we know that probate tax will be charged on the life insurance proceeds only if it goes to the estate. And when will proceeds of life insurance go to an estate? When the estate has been named a beneficiary or no beneficiary has been named. Now, choice 1, 2, 3, all three have a beneficiary named. Whether it's revocable or irrevocable is immaterial. And if a beneficiary has been named, the proceeds would go to the beneficiary. 4 and 5, 4 says estate as a beneficiary and 5 says he has not named a beneficiary. Either case, it will go to the estate and it will be subject to the probate tax. So the answer is 4 and 5. Answer is B. B for Bob. Try this question. I'll give you a minute and a half. So in this question, if you see, he has a non-registered account, which is a normal account, where he made $5,000 in capital gains. So taxable would be $2,500. He made $200 in dividends. Taxable dividend income would be grossed up by 1.45. So that would be $290. So total income in the non-registered account is $2,790. In the registered account, he sold his shares, but he did not withdraw any money from his account. Within the account, he sold the shares and transferred it from shares to cash. He only changed the form of investment. He hasn't withdrawn any money for his use. That means no cash has crossed the boundary of the RRSP account. So he will not be taxable on any part of the RRSP account, the registered account. So his total taxable income for this year would be $2,790. Answer is A. It's the same thing with the solution shown. I'll give you a minute to answer this question. Obviously, in this question, they're asking the most tax efficient way to structure a policy between the spouses and the beneficiary. Now, obviously, in case of spouses, the most tax efficient way would be for them to name each other as beneficiaries and pay the tax on the second death. So that means we need a second to die policy. So the first to die is wrong, we don't choose it. The joint and last survivor annuity is not relevant. So the answer can be B or D, a joint second to die policy. One is naming the estate as the beneficiary, other is naming the inheritor as a beneficiary. The question is also saying the most tax efficient. That means in which case would you pay the least tax? If you have named the estate as a beneficiary, you would land up paying probate tax on the life insurance proceed. But if you have named an inheritor as a beneficiary, you avoid the probate tax on the life insurance proceeds. So the most tax efficient is naming the inheritor as a beneficiary. So the answer should be D to this question. Please note here that it may not be the most efficient method on overall, because naming the estate might be okay in many cases. Okay? But the question as it is framed, the right answer is D. D as in David. Life insurance contracts and underwriting. I'm sure all of you know that life insurance is a contract between an insured and an insurer. The insurer is the company who's providing the insurance. That means who's promising as part of the contract to pay the benefit out if the person dies, if the life insured dies. And the insured, the policy owner, is promising to pay a premium for this benefit. These are the two parties involved, the insurer and the insured. There could be a third person called the life insured. The life insured is the person on whose life the policy is based. So if the insured is the life insured, that means the insured and the life insured are the same person, we call it a two-party contract. If the insured and the life insured are two different persons, we call it a three-party contract. Now obviously law requires that the insured has insurable interest on the life of the life insured. And insurable interest, law defines that you have insurable interest on the life of your spouse, yourself, your child, your grandchild, and your employee. Now if you want to insure anybody else other than these people, you need to prove your insurable interest, which means you have to prove that you have financial interest in the life of the person. Now, the insured is the owner of the contract and is the insured who names the beneficiary of the contract. The beneficiary is the person named by the insured to receive the benefits on death of the life insured. The named beneficiary can be revocable or irrevocable. Revocable means the insured basically controls the policy and can do whatever he wants with the policy without consulting the beneficiary. He can even change the beneficiary if he wants to. He doesn't have to consult or even inform the beneficiary. But if the beneficiary named is irrevocable, then the insured needs the written consent of the beneficiary, of the irrevocable beneficiary, to make any changes, major changes to the policy, which include transfer of the policy ownership, changing the beneficiary, taking a loan that is making a collateral assignment, or surrendering or cancelling a policy. The beneficiary has to consent, a written consent. So indirectly, when an irrevocable beneficiary has been named, the irrevocable beneficiary to a large extent controls the policy. Ultimately, it is the insured, the policy owner, who needs to take the decision, but he needs the consent of the irrevocable beneficiary. Now, this life insurance contract, it is a unilateral contract. Once the policy is issued, the insurer, that means the company, cannot make any changes to the terms and conditions in the policy. The company has to honor as long as the insured is paying the premiums. But the insured, on the other hand, has got his rights. He can cancel the policy whenever he wants. He can reduce the face amount. He can take loan. He can do many things. So because one party is free to do things and makes changes, whereas the other party is not, this contract is called a unilateral contract. This contract is also aleatory contract, which means that the insured knows beforehand how much money he is going to receive from the policy, because the benefit is fixed. But the insurer, on the other hand, does not know how much sum total of premiums he is going to receive from this particular policy, because death can occur at any time. When one party to the contract cannot estimate how much he is going to make from this contract, the contract is said to be aleatory. It is a contract of adhesion, which means it's a take it or leave it contract. When the policy is issued, it is issued in the standard form. It's a boilerplate printout of clauses. And the insured has to necessarily accept the conditions as they are written. He can't say, make a change in this condition for me. It's not bargainable. It happens in all large-scale contracts, because the party cannot monitor changes in individual policies. But rest assured that whatever applies to one person, one insured in the province for this kind of policy is going to apply to every other insured in the province. It's not going to vary between insureds, the terms and conditions. And it's a contract of utmost faith, because both the parties to the contract have agreed, have trust in each other. That means the insured is trusting that the insurer will definitely pay the money out on death. And the insurer is trusting that the insured has given correct answers and replies to all the questions in the application, based on which he has decided on things like premiums. That is why, if the insurer finds out later that there is a material misrepresentation in the policy, that means a misrepresentation that would have made a difference either to the decision to issue the policy or the premium charged, the insurer has a right to cancel the policy. This comes out of the principle of the contract of utmost faith. Now, when the application is received by the underwriting department, the underwriting department tries to analyze the risk posed by this insured or the life insured. Now, if the risk is standard, that means normal for that age, they issue the premium at the standard premium for that age. If the risk is higher, which means the risk is substandard, and the policy can be issued, they issue a rated premium. That means they increase the premium for this person. If the risk is such that it's not acceptable, they decline the policy issue. In case of certain substandard risks, especially like those with hazardous sports and occupation or traveling, many of these details are asked in questionnaires that form a part of the application. And many of the companies in this questionnaire give an option to the insured to select whether he wants a rating for this if found unsuitable or substandard, or he wants to exclude from coverage this risk. This is an option given mostly in life insurance policies. For example, let us say there's a person who travels to Afghanistan every 6 months. Now, the company may not be willing to take the risk on this person. So they may ask him, do you want to get rated for this risk? In which case the premium is going to be substantially higher for the insurance company to accept this risk. Or the insured has the choice of saying, I opt for an exclusion, in which case the policy will be issued stating death in Afghanistan not included. Death anywhere else will be included in the policy. So that's how an exclusion is written into a life insurance policy. But as I said, exclusions are rare in a life insurance policy. It's mostly by choice. When the insured does not want to pay the higher premium, they exclude the risk. But the insured has an option in this case. Compare this with disability insurance policies. In disability insurance policies, the premium is charged based upon your occupation. You know, occupations have been classified from low-risk occupations to high-risk occupations. Obviously, people at the higher risk occupations pay more premium for the same amount of coverage. I think it's common sense. If a construction worker and an office worker both apply for a policy for a benefit of $1,000 a month, I'm sure all of you will agree that the construction worker pays more in premiums because he is in a riskier occupation than the office worker. The point is that rating in disability policies is done for occupation automatically. So what do they do if they find a substandard risk, a medical problem or some such thing? Say the person applies for a disability policy, but he's had a back injury prior. Now, underwriter in this case is most likely to say exclude this back from coverage. He's going to issue a policy for the same premium as the standard person, but he's going to say your back is not being covered by this policy. Any claim arising because of back will not be entertained by this policy. Of course, this will be told in more technical terms. It might say because of discs so and so to so and so, whatever, but it doesn't matter. Essentially, the message is your back is not covered. Now, when an exclusion rider is written in a policy, the coverage is said to be a modified coverage. You can say with an exclusion rider, or you can say a modified coverage. So standard person will get a standard coverage. The modified coverage is for a substandard risk. Of course, if the risk is such that it's not acceptable to the insurer, he will decline issue of the policy. So if we compare the life insurance and disability insurance, in life insurance, substandard risks are 99% of the time rated. That means they charge you a higher premium. Exclusions are rare. In disability insurance, rating is automatic based upon your occupation, and for substandard risks, usually there's an exclusion or a modified coverage. Now, this modified coverage or exclusion depends upon the situation. Sometimes it's a permanent exclusion. Sometimes the underwriter might be good enough to say this exclusion we will review after 2 years. Whatever be the situation, there is an exclusion in the policy. It's a modified coverage. Sometimes what they do is they give you an extended elimination period. Say the elimination period normally for the policy is 1 month. They might say for the back injury, if you get your elimination period is 4 months. Sometimes they might give you a reduced benefit period. Say you buy a policy with a benefit of to age 65, they might tell you that for your back injury, we'll cover you only for 6 months. So whatever it is, these are modifications. It's a modified coverage. Exclusion or a modified coverage. So there is a slight difference in the underwriting of a life insurance and disability insurance policy. It's basically with respect to exclusions. Exclusions are typically the norm for disability insurance. Now, how does an underwriter decide or categorize the risk? They use different tools. One of the major tools are commonly used by most underwriters is the Medical Information Bureau. The Medical Information Bureau is a database set up by insurers in North America. Now, if somebody applies for a life insurance policy or any insurance policy, life insurance policy, and they find something substandard about this person, they write the information into the Medical Information Bureau. The MIB don't think is the database used by medical practitioners or some such thing. It only writes the code of the problem faced by this person. Say, for example, the person has diabetes or hypertension. It will put his name and put hypertension code or the diabetes code. So it is something akin to the Credit Information Bureau. If you have never taken loans, your name will not be on the Credit Information Bureau. Similarly, if you have not applied for any insurance, your name is not going to be in the MIB. But if you have applied for insurance also and you have got a standard policy, that means nothing wrong was found with you, your name will not be on the MIB. However, if you have applied for a policy and some problem was found and you were issued a rated policy or a decline, your name is likely to be in the MIB. It will be there. Now, the MIB is a confidential database, and to check this name on this database, client needs to give permission for both, for checking as well as writing information into the MIB. And this is taken as part of the application. There is usually an MIB notice which needs to be torn out and given to the client, and the client signs his consent or permission for checking the MIB on the remaining part in the application. So MIB is used to check on past history of insurance applications. MIB is the source to check on past history of insurance applications made by the insured. The next tool used is the attending physician statement. Most people who apply for insurance have some medical problem or the other. And usually what the underwriter does is writes to the doctor, the attending physician or the family doctor of this person, for a report which gives the current status of his health. It says what is the level, what is the medication being used, is it under control, this kind of stuff. And that is called the attending physician statement. It's used to check the current status of the insured's health. Then, as part of the process are the results of the medical tests that may be required when you apply for an insurance policy. They may take a blood test or urine sample or whatever. Those results go to the underwriter. Now, sometimes they might require you to go for a detailed medical checkup after going through your application, or the test results that they did on you point to some new problem arising in you. They may ask you to go for a detailed medical checkup on your situation. So medical checks also and reports from there form a tool that is used by underwriters. Another tool used by underwriters is called the inspection report. Inspection report is used to verify occupational and lifestyle information revealed in the application. Now, usually most insurance companies work with some investigative agency called an inspection agency. Now, when they want to find out some information about you, let's say the person claims to be a carpenter in occupation, but the underwriter has reasons to suspect that this person works on the roof, he's a roofer. Now, why would somebody claim to be a carpenter when he's actually a roofer? Because if he's applying for a disability policy, the premium for a carpenter will be less than that for a roofer, because the roofer is a riskier occupation. So in order to get a lower premium, he might have covered up and said his occupation is a carpenter. When the underwriter wants to make sure that this person is a carpenter, not a roofer, he will ask this inspection agency to find out. The inspection agency will visit this person at place of work and make sure whether he's a carpenter or a roofer, and inform the insurance company. So inspection reports are carried out for checking on occupation and lifestyle habits, for example, drug habits. So inspection reports are used to check information revealed on the application. It's not specific, not for medical or to check on your condition or to check your past history. It is to check on the current information revealed on your application, mainly about lifestyle and occupational aspects. And if underwriter suspects that you have some problem with driving, they may check your motor vehicle abstract to see the number of tickets, whether you got any driving under influence tickets or charges. All these kind of things will be checked. Now, based on all this information, the underwriter rates you as standard, substandard, or decline. These are the tools used by underwriting. Pay attention to these. It's simple. Now, a contract can exist in 4 states. It can exist in the state called in force, which means the client is paying his premiums regularly, and if the client dies or the insured dies, death benefit will be paid. Now, if the insured misses the premium payment, the policy goes into what is called grace period. For policies without cash values. If it's a policy with a cash value, when the premium payments have stopped, premium loans or the account will pay the premiums till the account is finished. If there is no more money in the cash value to pay the premiums, the policy goes into grace period. If the policy is in the grace period, and the grace period has to be a minimum of 30 or 31 days. So, if the person dies during the grace period, death benefit will be paid. Now, before the grace period is over, if the person is alive and he pays his premium, the policy just comes back to enforce. If the grace period is over and the premium has still not been paid, the policy lapses. When the policy is in a lapse state, no death benefit will be paid. And the insurance company needs to keep it in a lapse state for a period of 2 years. And during these 2 years, the insured has a right to reinstate the policy. Reinstatement is reacquisition of your old policy. Now, when you buy a new policy, all of you are aware that there is a suicide exclusion clause. Now, when you rebuy your policy again, when you reinstate it, a fresh suicide exclusion clause will start for 2 years from the date you reinstate. Your smoking status could be affected. Say the person purchased a policy when he was a non-smoker. He got the non-smoker premium. And during the interim period before it lapsed, he started smoking. Now, obviously, when he reinstates, the insurance company will change his premiums to smoker premium. Smoking status can be affected. And you know that all policies are incontestable after 2 years. Contestable means the insurance company has got a right to check into the answers for a period of 2 years. They can go check with your doctor, they can check into your criminal records, they can check MIB, wherever. But after 2 years, typically, the insurance companies stop checking on this, and the policy becomes incontestable. Now, once the policy is incontestable, the policy can be cancelled only if there is a material misrepresentation. Material misrepresentation means, as we discussed, it's a misrepresentation that would have caused the policy not to have been issued had the insurer known it at that time, or it would have resulted in increased premiums had the insurer known it at that time. In that case, the insurer cancels the policy. Normally, the insurer refunds all the premiums paid till that date of cancellation. So new incontestability clause, a contestability clause will start again, which means for 2 years from the date of reinstatement, the insurer can again check into all aspects about you, about the insured. So you can reinstate within 2 years of its lapsing. When you reinstate, you need to pay all the due premiums, all the premiums missed, plus any penalties or interest that the insurer might charge. Not only that, you have to do a medical again. So if the insurer now finds you unacceptable or your risk is too much, he can say, sorry, I don't want to give you the policy. He can decline it. Or he can rate you. So letting a policy lapse is not a good state to be in, because you need to do a medical again. Policy provisions, I'll just run through them. The form of the contract, of the insurance contract, is always in the written form. The entire contract consists of everything, not only the policy. It consists of the application, any correspondence with the insurer, the medical test results, any riders added on, any reinstatement, everything taken together is the contract. Misstatement of age or sex. When this misrepresentation takes place, this is a special misrepresentation, and the insurance company is not allowed to cancel the policy. The insurance company, though, can adjust the benefit to the age based upon the premiums paid. Same with sex. The benefit can be adjusted, but the policy cannot be cancelled. Incontestability and material misrepresentation, we just discussed it. Fraud is more serious than just a misrepresentation. When it's just a misrepresentation, it is tried under the Insurance Act, that means the civil law. But if it is fraud, if you have tried to intentionally cheat the insurance company, they can charge you for crime. Crime, which means it will be tried under the criminal law, and it is punishable, and they could charge you fines too. Grace period, we said, should be minimum of 30 or 31 days. It is mandatory for life insurance policies. Assignment, you can take a loan against a policy with cash value. And an absolute assignment means you can transfer the ownership of the policy. We will discuss these two separately. Reinstatement, we have discussed. Rescission right is the right given to a policy owner to cancel the policy within a certain number of days of his receiving it. Typically, most policies give 10 days. But the 10 days is not written in stone because there is no stipulation in the Insurance Act. These are voluntary provisions, and most insurance companies would give whatever they prefer to give. Some companies give 15 days, some give 30 days, but most give 10 days. Suicide exclusion, we said 2 years from the date of issue or reinstatement. Misstatement of non-smoking status. If this clause is there in a policy, it will state that if we find that you are a smoker and you have said you are a non-smoker, we have the right to cancel your policy. And settlement options. When death occurs, the beneficiary can decide to take the money lump sum, or the beneficiary can tell the insurance company, okay, keep the money with you and pay me interest while I'm living, and when I die, pass this to my son or daughter. That's an interest-only beneficiary. Installment option, the beneficiary can turn around and say, pay it to me over so many years, which means he buys a term annuity, term certain annuity. Or you can buy a life annuity, which covers the beneficiary for his entire life. Now, when there is a policy with cash value, you can, surrender the policy and get the cash value. Whatever is cash surrender value is there in the policy, will be paid to you. Cash surrender value is typically the account value minus some charges for surrender. These surrender charges usually start high and then keep decreasing, and usually after 10 or 15 years there is no surrender charge. So account value, you'll get whatever money is there in your policy. Absolute assignment means transfer of ownership. Let's say I own the policy on my life and I want to transfer the policy. Now, if I am going to transfer the ownership to somebody belonging to my preferred class, preferred class means spouse, children, grandchildren, or parent. If I am transferring to one of these persons who belong to my preferred class, there will be no taxation. But if I am transferring to anybody else, the policy gain in the cash value will be taxed. So that is what is there. You can also take a loan against the policy if you want. If you take a loan, most companies will give you 90% of the cash surrender value. However, there is a figure called the adjusted cost basis of the policy. Adjusted cost basis is the after-tax dollars content of your account. So if, for example, this policy has a cash surrender value of $270,000, he is eligible for a maximum loan of $243,000 and his ACB is $180,000. If he takes a loan, for example, of $200,000, then the excess over ACB that he takes in loan, the $20,000, will be taxable in the year he takes the loan. If he repays the loan, the first $20,000 within the same year, there will be no tax. Whenever he repays this loan amount, this $20,000 back to the policy, they will give him a tax deduction in that year. The government is saying, if you take a loan which is coming from your policy gain, pay me tax. Now, life insurance policies are creditor proof. On death, we saw it is creditor proof if a beneficiary has been named. If no beneficiary has been named, the money goes to the estate and it's not creditor proof. Now, what happens if a person owns a policy which has cash value and he's got creditors? If he's got creditors when he's alive and he's going to declare bankruptcy, the policy cash values are protected if the beneficiary named is an irrevocable beneficiary or a revocable beneficiary who belongs to the preferred class. So, otherwise the money will have to be paid to the creditors. So, irrevocable beneficiary or a revocable beneficiary belonging to the preferred class. Then it is creditor proof when the person is alive. When death occurs and you're going to make a claim, you need to submit the proof. The documentation required for an life insurance claim is the death certificate, the proof of age, and the beneficiary's claim. Death benefit will be adjusted for any loans, unpaid interest, everything. Now, for a disability policy, to make a claim, you will need the doctor's claim form. Doctor will have to sign on your claim form and give his observations.